little screen that would come up, and it'll have all the different TaxMatters classes, lessons, everything on there, okay? And there's a little button over here on the right, so you can kind of scroll through them. Like I said, the radio shows are there. They're great things too. You'll even see up on there any of the advanced lectures that they record. So if anybody has any information they'd like to gain from the, and then here's the ones that we did from the first and the second, where I did the problems and during the week, and I did the online, so those are up there too, okay? So that way you can go to one spot as opposed to each one on the web. So hopefully that'll work with the link. They are public videos. It's just sometimes hard to find them on the channel, so I think I'll send you the link and see how that works out so that you just have one spot. Maybe you can save that email or save that link to your desktop and be able just to access them all there at once and go back in, okay? Does appear everybody's doing their homework, because I do get the number of views that everything sees, so everything looks great on the homework. One reminder for tonight, you get an extra hour of tax time, all right, because the clocks fall back this evening, so that means you get an extra hour of doing tax returns and tax practice, okay? So you guys are in good shape. The other thing is too, you guys are actually, with the material that we've read and some of the things we've done, you're actually slightly ahead of the in-classroom, okay? You know, the online class is a different atmosphere where you do a lot of self-study, things like that. But with where we're reading and things like that, and the homework and the problems and the quizzes that I'm getting from everybody, most of the classroom time classes, you're at or above where they're at. So that's great, okay? All right, what we're gonna do with this morning is, I said in the one email that I sent out with everything, oh, one other thing, make sure you're always checking your spam. I found that when I've been substitute teaching at the classroom times, that there are classes, people that all of a sudden find everything I've been sending in their spam. For some reason, it has to do with our host of our email. We're trying to get that changed. There's what's called being on a whitelist. I'm not an IT guy, but that's what it was explained to me as. So we're trying to get back on the whitelist. What that means is that we're not on the blacklist, I guess, so that we don't have our emails constantly going into spam, because we experience it quite often, and it has something to do with our email host and our web host. I was on with them yesterday trying to fix some of that to get out some of the bugs that we have in the system as far as the accessibility and the errors that might come up. So always make sure you're checking your spam in there, because some things, I think it has to do with the words tax.com in our email. So, but always double check them there. This morning, what we're going to do is I'm going to be on here. If you have any questions on anything, I know we've gone through some questions. We've gone through the chapters. We did that on Tuesday. I'm going to highlight some things starting out. I'm just going to kind of highlight some of the points that I want you to know from chapter 14. I'm going to talk a little bit about chapter 7, okay? When you go to read chapter 7, don't panic. I'm not trying to turn you into a stockbroker or a financial wizard, okay? That chapter with capital gains can get very, very involved. You're going to read it. You're going to think, I have no idea what this is talking about. How do I figure out this capital gains? It'll be very simple for you to do, okay? So we'll kind of go in through the chapters. So let me get those ready. And I'm just going to hit some points on 14, talk a little bit about 7, and then I'm just going to be here for a question and answer time. So let me get that up. I got everybody muted right now, so, okay. All right. So Chapter 14 was the second part of non-refundable credits, okay? We covered a bunch in the first part. The ones that are in here are retirement savings, child tax credit. We talked a little bit about that when you heard the videos in 17. Residential energy credit, we'll talk a little bit about that. Adoption credit. For those of you that read this chapter and have children, you're going to start to think, well, now wait a second. I only get $1,000 for my actual biological child. If I adopt one, I can get $13,400. All of a sudden, adoption kind of starts to look a little bit more like the better avenue. But we'll talk about how those credits work. The last three, just the fact that you see on the screen, we've covered them. Don't get caught up in the credit for the elderly or disabled. It is a very rare credit. It's there for your knowledge to make sure if you have that individual that is low income and disabled, and I should say moderate to low income, disabled, and that disability is their only source of income, there is a modest credit there for them. And the last two with the motor vehicles, you just don't see, okay? I have a feeling those are going to disappear in 2016, but we covered them for the law that was there because we're doing the 2015 laws, okay? As I said here, we're going to kind of talk about these credits. They're all in the section, as you can see there, in page 14.4. It's the ones that have retirement, lines 51, 52, 53, and then 54 is kind of our catch-all, if you will, on the non-refundable credits. And again, non-refundable credits, those are our Pacman credits. They just eat and eat and eat till the tax bill's gone, and then they're done. Okay, we did study with the child tax credit that there is a refundable portion. So if you have a tax bill that is less than $1,000, which the child tax credit is, and that child tax credit eats up your tax bill, if there's a remainder, you will still get it. So if you have a $750 tax bill, the child tax credit eats that bill, leaves $250 that goes down to the refundable portion, and is down there at the bottom, and you get that in your refund, okay? All right, retirement savings contribution credit. As it says right there in the paragraph, it is a non-refundable credit available to low-income taxpayers who make contributions to their IRA individually or through an employer plan. What the credit is basically the government saying, thank you, we appreciate you funding your own retirement. You know, hopefully all of us that are here today that are younger than myself will still see the Social Security, but it is a way for people that are funding their own retirement, and especially if it's somebody that's giving a bigger portion than somebody else to their retirement, they can get this credit. As you can see, it's up to $1,000 for a single and $2,000 for married filing joint, okay? On your W-2s, if you remember when you're putting them in, you see that one section with the 414H SUB in the box 14 area that you see a check and say, is this eligible for the 8880? You can always check that box there, okay? It may or may not, depending on your income level, make somebody eligible for this credit. Also, in box 12, if you have a D code, which you remember is the 401k, you can see that that form would light up on your tree on the left should anything be qualifying for what you're contributing to your 401k through your employer. Also, we'll talk about contributions to IRAs from, say that you write a check, or at the end of the tax year you decide to open an IRA to lower your tax bill. We'll talk about a lot more of that when we do retirement in Chapter 8 and adjustments to income later on, okay? All right, so we have the retirement credit. You can see that the AGI is kind of in that low end of the middle class, you know, middle class to lower income for those individuals. You know, the credit is one of those ones that decreases as you approach the income threshold, so it's not a credit that you would get a certain amount, you know, 1,000 right up to that threshold, okay? And then you can see who's the qualifying people, all right? Granted, Right there it says was born after January 1st, 1998. Okay. All right. There's the form for the 8880. Okay. Just make yourself aware of it. Again, you can see right there in the middle on the paper form the factors that you multiply your amount by decrease very quickly as your income increases. So it's a credit that is very good for somebody down, in that mid 20,000 and below, but then phases out as it goes up above for the different filing statuses. Child tax credit, okay, $1,000. This is the government saying here's $1,000 a year per a qualifying child, because that is what it costs you to raise a child. It's what the government has figured. Okay, obviously not true, but it is a credit that you would get per child on the return. The qualifying child has those tests. Again, the tests are very important to know, because when you have somebody that you're doing a tax return for and they're asking, can I claim my child for the child tax credit, they have to meet the test. The test is basically answered for you when you put the children in under the main information sheet. Because you can remember, we put their name in, we put their social security, date of birth, their relationship, did they live with us, are they our child that we can claim, okay? Once all those are in and we answer those questions accurately, it will allow the child tax credit score to be checked on that line, the CTC, which is automatically checked, okay? All right, and you can see that there is an income phase out here, okay, on the child tax credit, all right? That phase out, I want you to think of as a light bulb. When the light bulb goes on, that means we get the credit. As we approach the phase out, the light bulb gets dimmer and dimmer, which means the credit gets smaller and smaller. Once we hit the threshold of the phase out, our light bulb goes out. So in this case, if you have a family married filing jointly, okay, all right, that makes $150,000, chances are, it doesn't matter if they have 1 or 10 kids, that they're not going to receive the full child tax credit, okay? So that's where you need to make sure on that one, okay? Because some people will say, how come my kids don't show up? And you have to inform them that, well, because your level of income, you have phased out, or your light bulb's gone out, or whatever you want to say, that you're not eligible for the credit anymore, okay? All right. Let's go down to quite a few pages on the forms here. All right. Residential energy credits. We're on page 1416, okay? Residential energy credits, great credits. They used to be wonderful credits. I don't know anybody that remembers that, 5, 8 years ago, you go in to buy a new furnace or a new refrigerator, and if it was Energy Star compliant, it had the little little yellow sticker on it that said how efficient and how Energy Star rated this is, that you would be able to get a break on your tax return. Or you'd see the commercials for the furnaces or whatever it may be to heat your house, and they said, well, if you buy this efficient furnace, you get $1,500 on your tax return. That credit that used to be $1,500 is now $150. Okay, it's a credit that has really diminished as far as things for the residential side of it. However, there are portions of it that are very lucrative. Okay, you can see here for the residential energy efficient property credit in part 1, if you're doing solar energy, wind, geothermal, or the fuel cells, you can get up to 30% of that cost as a credit on your tax return, okay? Now, I don't know if anybody's ever put solar panels on, or if anybody has one of those big windmills in their yard, or if anybody's really bored and they want to dig a really deep hole to get the heat from the center of the earth to heat their house, okay? But those are those credits, okay? All of those are very expensive installation. Solar panels, putting up one of the windmills, digging that hole. I actually have a client that is a merchant marine, and while he's home, I guess that's what he does in his spare time, is he installed geothermal heat in his house. Basically, he has no utility bills any longer besides a modest electric bill, but you know, he got a nice credit, 30%, but it also cost him almost $50,000 to install everything. Okay, so again, solar panels are not inexpensive either. All right, so those are credits. Those are for people that install those. I know you see commercials on the TV about people with the $18 electric bills. Well, you know, they've probably installed solar energy and they have those fuel cells to store the power. But, you know, most of those I've seen on tax returns, it's $10,000 or more for installation, and it takes a long time to recoup. But there are great credits up to 30%. Okay. The credits that we deal with most of the time is the ones that just deal with the improvements to the house. And again, this is improvements to an existing house. On the form, you'll see a question that asks you about, was this a new build or an existing house? These credits typically only come into play if you're improving an existing house. It is a $500 credit lifetime after 2005. What that means is if last year in 2014, you took $150 of this credit for your new furnace, then you only have $350 left to take in future years. As you can see there for the residential, you can get $50 for a new air circulation fan, $150 for the furnace or hot water, okay? If you do exterior doors or windows, $200, all right? So those are things. If you put new insulation, say you put new siding on your house, and you put insulation under it that makes your house more energy efficient, you could get a portion or up to $500 credit, okay? All right, so we have that. There's the form for it. Again, I talked about part one is mainly directed at the larger ticket items. Those, you get a 30% with the calculation of the credit, okay? All right, part two is where we see most of it, especially in this middle section. One other thing too, for the energy credit, if somebody puts one of the new metal roofs or architectural grade asphalt shingles on that meet or exceed the Energy Star program, they can get a credit for that, okay? All right, adoption credit, page 1420. This is a credit that you can get for adopting a child that is up to $13,400 per child, okay? All right. You'd only get that credit for your qualified expenses, and if your employer is giving you a credit assistance or adoption assistance program, anything above that, okay? So this is basically a credit for you for your expenses to adopt a child, all right? If we go to the next page here at the top, talks about what qualified adoption expenses are. There are those adoption fees, attorney fees, court costs, traveling expenses. So obviously if you're, you know, adopting a child that is maybe from a foreign country, you'd have traveling expenses, and then you might experience readoption expenses. Those would be if you adopted a child from Guatemala and you adopted them in Guatemala, then they're your child. However, when you come back to the United States, you have to adopt them again because there's no reciprocal law for the adoption with that country. You'd have to adopt again, and those expenses can be, you know, written off, okay? And again, over and above anything that your lawyer might get, or excuse me, that your employer might give you, or anything over and above that maybe the county or state. If you have somebody that's a foster parent, sometimes they will adopt the child. And if they're a foster parent, they might be getting a stipend from the county or the state to have that child there. And then they also may get a stipend to help adopt the child, okay? Expenses that do not qualify, obviously here are some of the things that funds were received, as I said, from any state, local, or federal program. If you're going on to the black market to adopt a child, that does not count as expenses that you can do it, okay? Just like we've talked about with other income. If you choose to have other income that is illegal, you can put it on your taxes, but you know, it's not something you can do here for the adoption credit. Surrogate parenting, the adoption of a spouse. If you marry somebody and then you decide to adopt the child to make them legally yours by court order, or anything that's reimbursed from the employer, okay? Now, the one thing is with this credit is, let me find the section here, okay? There's some timing rules. This credit kind of almost has a window. And what I mean by that is it almost has a window where you can take the credit over several years, and it has a carry forward, okay? Or I can claim the credit in the year prior to the adoption being finalized. So if right now I am planning to adopt a child and that adoption is going to be finalized in January of 2017, if I have court costs, lawyer costs, things like that, I could take the credit on my 2016 return, use that credit to offset my cost. Then anything that's remaining could be carried forward to the year when the adoption is finalized, okay? So that I get all $13,400 of credit. That way, if I took the credit this year and didn't use it all, I don't lose it. I can still use it so that I get my full $13,400. Now, equally, when a credit is something for a special needs child, okay, you get that whole credit, $13,400, pretty much no matter what. What I mean by special needs, it's not necessarily just that child that maybe has physical or mental disabilities. It may even be because the child is a twin and you're adopting the twins. Or it may be the case that is an older child that's hard to place. Or that you have a family they don't want to break up. Or even children that come from different ethnic or backgrounds or areas. So that can allow you to have the full credit no matter what, okay? The designation of that is definitely done by the agency doing the adoption, okay? The IRS really doesn't have anything that outlines it, but most of that is, as it says there, child whom a state has determined has special needs, okay? And on the paperwork that they would come in with for the adoption, it would be noted on there. Most caseworkers for the adoptions through the state and things like that, they, have that there, okay? All right. And there's the form for it. As I said, up here at the top, you can see that we have our qualifying child. Check in the box, special needs. Child's identifying number. The way it's stated, it doesn't necessarily mean that there is a Social Security number. They might have a temporary number for the identifying number, okay? Sometimes there's cases where adoptions are going through, and because the parents will not release the child's Social Security number, but we need to put the child on the tax return, we might need to do an ITIN, which is an identifying tax ID number, so that we can put the child on the tax return. It might not be the same as their Social Security number when the child's been fully adopted, okay? So there are instances where you cannot obtain that Social Security number for the child, okay? And then you can see right here on line 5, you see that the credit, that's the amount, but on line 5, that's where you will put the adoption expenses. And again, qualified expenses for the things you paid in the tax year. If there is some left over, okay, it will carry forward, all right? Okay, so don't worry about that, it won't, all right? You can see here down on the bottom that it has credit carry forward, if any, from prior years. So if we had paid some money in 2014 and not used our $13,400 on line 13, either we would enter that or it would be carried forward if it was somebody that was in the system, in our tax system for returns from the previous year, okay? All right. There you can see on a W-2, they're an employer-based program, 12A, it shows that T code there of $10,000, okay? And that's where that would go on there. All right. All right, let's see here. Okay, here's the credit for the elderly or disabled. We're on page 1442, okay? The credit for the elderly or disabled is a non-refundable credit available to taxpayers who are either age 65 or older at the end of 2015 or retired on permanent disability and have taxable disability income, okay? So, again, if they have disability income that is taxable, then this is a credit to help offset that tax or eat up that tax, okay? Again, very rarely will you see this credit, but you need to know it's there because if you do a tax return for somebody that has taxable disability, they may receive this credit to help them offset that. Typically, if somebody is on Social Security or Social Security disability and that is their only source of income, they may not even have to file because that is not taxable income. But if because of other things that are on their tax return for income may generate some of that Social Security or Social Security disability to be taxable, then this is where we would do the credit, okay? We would do a Schedule R, and then the credit would be showing up on 54C. The software will automatically determine if you have somebody that qualifies for this, okay? You just need to understand the law, and then if you see this, that there's somebody that falls into this category, to make sure that when you do the tax return that the software in TaxWise has given you the Schedule R and made the calculation of the credit, okay? There's a lot of times that I will see somebody that I think qualifies. I don't see the credit. I'll go to line 54C, go in and take a look at the calculation on the Schedule R and see that their income just doesn't meet the qualifications, okay? All right, okay, so we have that, all right? And then as I said here at the end, we have alternative motor vehicle and the battery one, okay? Don't worry about it, all right? Those are things that you're just not going to see, okay? All right, so we have those. I'm going to open up the mics. You can mute your mic if you want to, and I just want to know if anybody has any questions on 14 before I cover capital gains. Yeah. All right, any questions from anybody?
Oh, no.
That's good.
I'm here.
Who's that?
Cheryl.
All right, Cheryl, you got a question?
Oh, no.
Okay. Okay. All right. Those credits, again, are the refundable ones, okay? All right, so those will be, again, those are the topics from that chapter that you need to be aware of. All right, no questions from anybody on that one?
I have a question on a couple of things.
Sure.
The lifetime limits and the adoption credits that can be spread over time.
Mm-hmm.
Who actually keeps track of, say you've used so much of a portion of it one year, who keeps track of it for the next year's records?
Well, you would be responsible for the record keeping. Obviously, if you file back-to-back tax returns claiming that credit for the same child, you're probably going to get a love letter from the IRS, okay? Because they will know. It's kind of like, I don't know if anybody's ever done the first-time homebuyers credit, okay? If you had that credit for the first-time homebuyers back a few years, and if anybody forgets, if we get a new client that forgets to tell us about it, or they forgot that they have to make their payment on their tax return, about 6 months after they file their tax return, they can't figure out where the refund is, or the refund was reduced, it's because they forgot to tell us about the first-time homebuyers credit. Equally with the adoption credit. Returns come in where they have 2 successive years and the limitation is reached or exceeded. They'll probably take part of the refund and not give you that portion of credit, or they may hold your entire tax refund and send you a letter saying you need to support this. Okay. All right, anybody else?
Well, here we go again. It's really bad judgment issues, not
All right, so I'm going to mute everybody again. I'm going to get chapter 7 up. All right. Okay. All right. Now, I am sure that everybody read chapter 7 and they looked at chapter 7 and they probably said, this makes absolutely no sense. Okay. We are on capital gains. All right. And this is one that sometimes is very tough to follow. But we're going to try to simplify it the best I can. Okay. Typically what I do is, and I would, if I had a, no, I don't have my, let's see here. Okay. Typically what I'll do is I'll start like this for basis. Okay. And I'm going to use hand gestures since we're on the camera here. Basis. All right. The basis of property. No matter what it is, that is the value of the property. That is the value when you took possession. And if you're unable to determine that value when you take possession, you do the fair market value. Okay? Now, I take possession of this property. I have my basis. If I sell it for greater than the basis, the difference between my two hands is capital gains. If I sell it for less than the basis, the difference between the two is a capital loss. Okay? So you can have a gain or a loss. All right? Now, the other thing that takes place with this is we have my basis. I can adjust my basis. Say that this is investment property that is like a rental property, okay, because that would be considered investment property. My adjustment to my basis could be a new roof, okay? All right, so I have my basis. I have what I sold it for. I'm trying to make sure that my capital gains is minimized. If I put a new roof, new siding, new appliances, you can see how I close my gap because I raised my basis, all right? That is the way that capital gains works. It's always based off the basis of whatever you paid for it. If it's a stock that I own, okay, I bought that stock or I inherited that stock or it was gifted to me, whenever I took possession, that is my basis. If I sell that stock for a price greater than what I obtained it for, capital gains. If I sell my stock as a loser, capital loss. Okay? So that's basically the way capital gains works. Like I said, sometimes the best way I have to have people figure it out is put a line in the middle of paper, that's your basis, write the value, and then decide which side of the line. If I'm up here, it's a gain. If I'm down here, it's a loss. Now, I can put things in here that I can add to my basis to shrink my gain. Okay? All right? So, best way I've ever found to teach it, I'm going to have clips up. Chris, actually, he did a great job on it, but his share screen wasn't working, so you can't see his tax return, but his description of things, he does a great job with capital gains, so that'll be one that'll be up there for chapter 7 from Chris that talks about capital gains too, okay? But the big thing I want you to understand, basis. That's what it is, the value that you took it when you got it, okay? Now, in here, this reads like a finance book for a college graduate class, okay? So don't get caught up in that. As I said, basis. That's where you start. If you don't know what the value was when you took ownership, it's the fair market value, okay? Increases mean a gain. Decreases mean a loss, all right? Those losses and gains can be short-term, which means less than a year that we had it, or long-term, more than a year we had it, okay? So that will be the transactions on that, all right? As I talked about, the basis of the property, you can see there on page 7.4, cost basis, what was it when I took possession of it? Adjusted basis, again, I talked about that. I have a rental house, I have this, but I put a new roof on it, so it raised my basis, okay? So that's really the best way to remember that. Don't get caught up in a lot of the legal terms, or excuse me, financial terms that are in there, so that you can kind of make sure that you're just understanding the basis, okay? All right? Basis other than cost, as it says, that's when the cost cannot be used as the basis. In these cases, fair market value or the adjusted basis may be used. Great example, okay? A basis other than cost. If I inherit mom and dad's house, they built that house in 1955, they probably paid $2,000 for it, okay? I now have possession of the house. I have no idea what the value of that house is. Obviously, I don't want to go on their cost, because then if I sold the house that they paid $2,000 for $100,000, I have a lot of capital gains. Well, so I have to figure out a basis other than cost. That's where fair market value. What is the appraised value of that house, or what would it take if I sold it at the time I took possession? I might have to go to the assessor or something like that to find the value of that property or that house, so I know what my basis is. And then I can take and see if I have a gain or a loss based on selling that, okay? So again, somebody else's house, that's that way, all right? Now, here are on page 7.6 examples of adjustments to basis, all right? And as I said on these, you can see different things that would do, okay? If anybody's ever fought the appraisal of their house, okay, you can see there under local improvements, the county assessor loves to come in and say, I think your house has just increased $10,000 in value for property tax because we put a brand new sidewalk in front of your house, okay? Well, must be a very nice sidewalk that makes my house $10,000 more valuable. You can fight that, whatever it may be, okay? New utility hookups, things like that, all right? As you can see on the right, big one that comes in, decrease the basis. Chances are you have a decrease if there's been a casualty or theft loss with the insurance. If your house was in a flood or something like that, chances are that's going to decrease the value of the house or decrease the basis, okay? All right? So we have that. Now, in here is some things about this property changing hands, all right? The big ones I want you to be aware of is talking about the property transferred from, say, an inheritance or received as a gift. If you receive a gift, if the gift for a married filing joint household is less than $28,000, we don't have to worry about it. That is below the gift tax threshold. If it's a gift that's above that, we may have to do a gift tax return. Gift taxes really don't kick in until the value of the gift is greater than $1 million. So, chances are, if you have somebody that's going to be giving you a gift of a house that is valued at greater than $1 million, you're probably not going to be sitting here with me on a Saturday morning, okay? Because you got $1 million house that you're living in, all right? Inherited property, same thing with the fair market value. Now, the other thing that's in there is what's called a like-kind exchange, all right? Best example of this is I own a rental house, okay? When I go to sell that rental house because it is not my residence, I would have to pay capital gains on it, all right? However, I can avoid capital gains if I take the proceeds from the sale of that house and I buy something similar. I own a house here in Amherst that is a rental house. I've decided I'm going to sell it, I'm going to retire, I'm going to move to Florida, okay? And in Florida, the house that I'm going to live in is a rental house, okay? So it's kind of a seasonal place for me. That would be a like-kind exchange. I can hide my capital gains by taking the proceeds and buying something similar. okay? That's what the like kind means, all right? There are lawyers that have holding companies where you can sell your rental to them and avoid the capital gains tax by them putting it into this holding company. It's called a 1031 exchange. So if you ever have anybody that's selling a rental property, you might want to talk to them, because rental properties, you know, after you've had it for 30 years and you go to sell it, chances are you've got a pretty sizable amount of capital gains, okay? All right, now, let's go down here. There's the form 1099B. We're on page 711, okay? It's a neat little form, but I hate to tell you, you're never going to see one of these, all right? This is the IRS version of a sale of property or a stock, and you can see we're in box 1A right here. It says description of property, all right? Never done this way. It is never done this way, okay? I'm going to scan in. I did them from my class last night. I actually found one of my clients. A lot of you may have seen this document, okay? You may have seen something like this. Comes from your, you get it at the end of the year, it comes from your, maybe your mutual fund or 401k, you know, your bank. This one's from Key Bank that shows all your investments, okay? The thing that is on the front of it, remember when I talked about unearned income with all the different categories, these have a 1099 INT and a 1099 dividend thing on the front. Plus, they have this little guy right here, 1099Bs, okay? And again, I'll scan this in and send this out to everybody, okay? This 1099B talks about my stock, all right? And this is the way you will typically see them, all right? It'll show the date acquired, date sold, proceeds, everything like that, all right? So when we sell stocks and bonds and commodities, it will be reported to us, and then we have to put on tax return. I'm going to show you this in a second. We're going to go through a little bit of a problem, okay? So we'll come back to this because there's a lot of things on here that you really, it's better to see it in action than try to read it, okay? Now, the one thing I am going to talk about before we go there is the sale of your personal residence, okay? If you have a home that you live in and you have lived in it for at least 2 of the last 5 years, you do not have to pay capital gains on it if your profit from the sale of that house is less than $250,000 single or $500,000 joint, okay? So what I'm saying is, if you bought a house for $500,000, you and your spouse, okay, and you turn around and sell it for $1.1 million, okay, that is greater than a $500,000 capital gain, you would be subject to capital gains tax on that $100,000, okay? Don't know many people in housing in Western New York that have $1 million homes, okay, unless you're running around with the pagulas, okay, and, you know, other families like that. So there's not a lot of $1 million homes, but that would be where you would have to report that. And again, also have to report the gain if you did not live in the 2 of the last 5 years. Example of that, my mother and father lived in Colorado. They had a home. My father passed away. My mother moved back to the Midwest with the rest of her family. We had the house in Colorado. We were trying to sell that house, okay? Because she now has a residence in Iowa, that residence in Colorado is not her main home. So we ran in and we're running up against the clock because we had a difficulty selling the house in the location that it was at because we were getting to where she had not lived in it 2 of the last 5 years. Once that barrier was broke, even though it had been her primary residence and not a rental, we had to pay capital gains on that house, okay? So that's an example of where not living as a primary residence in 2 of the last 5, okay? Main homes, house, houseboat, mobile home, co-op apartment, condominium, okay? All those things that you own, if you sell them, okay, Again, if you're living in a houseboat and you sell it for more than a $500,000 profit, it's a really nice houseboat, okay? That's where that profit. Now, equally, if you have the loss of the sale of your home, okay, as it says down here on the bottom of page 719, loss on the sale of personal residence may not be deducted. So in capital gains on everything else, if we have a loss, we can take it. But because if it's our primary residence and we are excluding gains, we cannot take losses, okay? So what that means is if you have a $100,000 house, you sell it for $80,000, and there's nothing that you can do. You have to take that loss, okay? You can't claim that loss on your taxes on capital gains. There are some other things that we'll talk about later when we do itemized deductions that we can maybe do with that loss. But as far as a dollar for dollar capital loss, like the sale of a stock or a rental property, we can't take it, okay? Establishing residency, okay? Establishing residency, we have, all right? Those are where those are listed, okay? So we have residency there, all right? Typically, if your mail, your voter ID card, your federal and state tax returns, your driver's license say one residence, that is your state of residence, okay? Or it's near where you work or where you bank or whatever it may be. That's where, you know, if somebody has a home in New York and a home in Florida, as the example talks about, those are the determining factors, okay? All right, okay. As far as the 1099-S, if your realtor or your broker that sold the house issues a 1099-S, even if you're not responsible for capital gains, if a 1099-S is filed, you must put that on the tax return. So even if you have the exclusion because it was your primary residence, okay? If you do have capital gains, here are some expenses that you can go through, okay? All right, hold on one second here. Okay. We had a couple questions here. What would be an example of theft or loss that decreases the basis? Again, kind of what I talked about there, where it was about the, you know, if there was damage to the house, flood, something like that, that decreased the value of the house. You know, that's where that adjustment with that decrease in that basis would be, okay? And then we had a question about bought a house for $100,000, lived in it for 2 years and rented for 3 years, sold for $150,000. How does that work? Well, there would be two things in there. You would have to recapture the rental portion of it because you were in the materially participating in renting. So your basis would be adjusted for the depreciation. And as long as that adjusted basis and what you sold it for did not exceed $500,000 for married filing joint, you would not have to worry about the capital gains, okay? So that's kind of a hybrid situation, but because you're materially participating in the rental, you have to recapture depreciation. We'll talk about that more when we get into the chapter 9 on rentals, okay? All right, okay. Now, we've covered that. Reporting gains or losses. Again, when you're reading this, you're thinking, oh my goodness, what have I gotten myself into? Okay? So, what we're going to do is I am going to go back and I'm going to bring up a tax return here. And I'm going to show you. One second here. All right. Okay. Just 1 second here. Get this set up. Okay, if you want to grab your workbook and the workbook with the problems in it and go to page 70, okay? It's workbook problem 7-2 is the one that I'm going to use here, okay?
What page was that?
Page 70 in your workbook.
12,000 hairs per square inch. It's the
Okay.
insulation to keep some sort of heat and temperature fine.
Okay. All right. So this is our problem for, and for those of you that are Winnie the Pooh fans, this is Christopher Robin's tax return, okay? So I don't know if anybody recognizes the name, but if you're a Winnie the Pooh fan, this is Christopher Robin's that you'll do on this, okay? All right. And let's see here. All right, I have all the W-2s in for this one. There are a couple of typos on this if you want to make note in your book. The first one is on the information sheet where you have all the biographical, okay? You can see that Christopher's wife, Elaine, her date of birth, change that to 1/25/1972. If she was born in 2149, we have a problem, okay? All right? Either that or she's friends with Walt Disney and she's frozen. Okay. The other one is on page 73. At the bottom, there's a W-2. That W-2 should be for Chris Robbins, not Elaine Robbins, okay? All right. Now, I have all this problem in here, but what I'm going to do is I'm going to put in the things on pages 72 and 73 for our stock, okay? Now, this is where I'm going to kind of explain basically the last half of that chapter, all right? So, what's going to happen here is I'm on page 1 of my 1040, all right? And again, you know, this is, let me make sure, yep. We're recording this, so you'll be able to come back to this, okay? But I'm on 1040 page 1. I'm going to go down to line 13 where it says capital gain or loss. Schedule D, okay? If you remember from me talking about the Schedule B, as in boy, the Schedule B is a great form. Everything for interest and dividends goes on the Schedule B, but nothing goes on the Schedule B. Exactly the same case for this. Everything for capital gains goes on a Schedule D, but nothing goes right on the Schedule D, okay? I know that sounds like an oxymoron, like I keep saying jumbo shrimp, but I'll show you what I mean, okay? So, on line 13, I'm going to go over to my total box in the corner. I have my little link, or I'm going to hit F9, and I'm going to get my Schedule D, okay? Click on that. We'll open it up. There we go. There we go. Okay. So we have our Schedule D. So once we're on that Schedule D, all right. Once we're on that Schedule D, this is where we see short-term in Part 1 and long-term in Part 2, okay? What I'm going to do, this is where everything's going to go for me, all right? Now, I'm going to go under the short-term box. I'm going to hit a little link. And what you'll find with a lot of things with the software when you're putting the information in there, all the forms that you use typically have a worksheet inside of them. Just like we saw with the interest and just like we saw with dividends, we really don't put it right where it ends up, or on the 1040 we have a worksheet. In this case, I have a capital gains worksheet. I'm going to open that, okay? Capital gains worksheet, all right? So it looks, and we're going to want to go up the top. This is where we get into the conversation and summarize all the things that were in the chapter, okay? You can see I have A, B, and C codes at the top in red for short-term transactions. It's an A if the basis, remember our baseline, if the value when we took possession of it is reported to the IRS. We put a B if whoever sold it to us does not know the basis, but just shows the proceeds, that is a B. And a C is we don't know either A or B. An example of a C would be somebody that's a flipper. And what I mean by that, they buy a house in January, remodel it, and sell it in July. That would be a short-term capital gain where nothing was reported to the IRS, and they would be responsible for putting it on their capital gains. Equally, you see the D, E, and F codes. Those are long-term for anything we've held greater than a year. Again, with the basis either reported to the IRS or not reported, or we don't know the basis. F, chances are, that's where if you have to report something about your home, that's where it would be, because the basis of that house is not being reported to the IRS. You have to determine that. And it's not going to go on a 1099-B. It may go on a 1099-S, or you know what the house was sold for from your closing papers, okay? Now, I have Stocks and More, the 1099-B that's on page 72. I'm going to put that in there. So I have STON company. All right. If I take a look, my 1099 red column, I have to use that from the information at the top. In this case, when I look at the 1099-B that's on page 72 in the workbook, I have a date of 2000 and a date of, when it says current year, 2015. That's greater than a year. So I have long term. Next thing I see is that I have a cost basis, so that I know my cost basis. In this case, if you look, long term, cost basis is on the form. I'm going to use the code D. Okay? D as in dog. All right? All right? Now, what I want you to notice on the tree on the left, what was created automatically right above my worksheet. Remember in the chapter they talked about 8949s? There it is, okay, 8949. So it made that form for me. We'll come back to that in a second, but let's get the rest of our information in here. We bought the stock in 2000, all right. We sold the stock in October of 2015. My proceeds or the sales was $12,200, okay? My cost basis, what I paid for it that shows up here, is $9,021. So as you can see over here in column H, I have my gain, and this S/L means short-term, long-term, okay? That's kind of driven by the code that we put in there. Now, F and G, the code and the adjustments. If you'd like to look at the code, you can. Typically, the only one that you're ever going to see is the letter W. What a W is a wash sale, all right? What I mean by that, I woke up this morning, had a cup of coffee, thought it would be a great idea to buy Samsung stock, okay? By noon, when I'm having lunch, I hear all the batteries in Samsung phones are blowing up. Bad idea. I sell my stock right away. Well, chances are that's going to be a wash sale because I bought and sold it the same day, and there's not really a big change in the value of the stock, okay? If I hold on to it for a day, it might be the case, all right? And for those of you that follow the news, Samsung's in real trouble now because their top-load washers have been recalled because the doors are flying off and hurting people, all right? So Samsung's not in very good shape right now. Okay, so we have that. Everything's on there. Now, if we go back to the tree on the left, the 8949 we have there, okay, we can see my 8949 has been generated. If I click on that, here's that form that I need to put on my tax return. It shows the code D, long-term transaction, basis reported to the IRS, and you can see my stocks at the bottom, all right? So everything is all set. It will even calculate what my capital gains rate should be for that, all right, by what I put on my worksheet. Now, as we said, everything on this goes on our Schedule D. So if I go up to my Schedule D that's in my tree and I click on page 1, I can see Part 1, short term. Well, there's nothing there. But if I go down to long term, there is my stock transaction reported as it needs to be on the Schedule D. Okay? So you can see how important this little capital gains worksheet is. It helps us generate the 2 forms that they talk about in the reading and put them in the right spot. All right? The reading is there for you to understand the flow of the sheet and what each line is and the terms that are involved. But as far as seeing how this works, it's very good to see it within the software. Okay? Now, I have my other stock here. All right? That one is LMNO stock. Okay? All right? And that LMNO stock, okay, if I look at it, I bought it in October of the current year and sold it in December of the current year. So that makes it short term. I held it less than a year. So in my next column for 1099, I have a short term and I have the basis, so it is a code A. Okay? All right, so I'm going to put it in that I bought it. Okay, in 2015, and I sold it in 2015. Okay, my sales or my proceeds from the sale of that stock was $1,214. The cost or other basis was $13,000. So as you can see here, I have a loss on that one. Okay, I have a $2,800 loss. Again, we go over this tree on the left. We can see another 8949. This time it is short-term A's. Our other one was a long-term D. So you can see each one of these is going to generate depending on what the 1099 code is for what that's going to be. I go look, here's everything I need to know. My 8949 shows A, short-term basis, and it shows my loss. If I go to my Schedule D, I can see in my short-term section, here is my stock, my loss, all right, because it says net loss or gain. As my long-term there, then the Schedule D, I follow it all the way back to my 1040. There is my gain and loss put together for a total gain of $372, okay? So you can see how the gain and loss. So everything that you do that has anything to do with capital gains that we've talked about in Chapter 7 is going to go on that capital gains worksheet. Like I said, with the investment property, we'll talk about that a little bit later when we do rental property, where you're selling a rental property so that we have the information on that, okay? Now, I'm going to show you one other thing here. I'm going to go back to capital gains, and I showed this in my class last night, so this may be a repeat from the video, okay? But sale price, cost. Well, when I bought this stock, it was $20,021, okay? I had a $9,000 loss. I don't pick them very good. LMNO stock went in the tank very quickly, okay? So I have a loss. All right. Again, on my short term, it shows my loss. If I go to my Schedule D, all right, it shows my loss and my gain from my two stocks. However, if I go to the main page, it only shows $3,000, okay? You can take no greater than a $3,000 loss on capital losses in a single year, okay? If I go over to my Schedule D, Worksheet 2, all right, you can see here that it calculates my loss carryover. So I have a loss, all right, and I have a remainder of a loss that will be carried over, okay? So it shows here short-term capital loss carryover. Next year, I have $3,628 that will be on my tax return that I can use again and put it against profits. Where we see this? 2008, when everybody had their IRAs and their stock take a bath. Some people have over $100,000 in capital losses from that year, all right, because all their stock went, you know, belly up. Well, they have that loss, but they can only use, of that 100,000 plus, $3,000 a year, okay? So that's where the carryover loss comes in. Now, that being said, okay, you can, in that, if I have a great year where I make a $200,000 capital gain, I then have that loss to put against it. If you have a $200,000 gain in the stock market, you're doing really good, okay? So that's where the capital loss and capital gains comes into play, all right? But again, on this one, with the problem, okay, we're just showing the loss, and then the loss kind of goes against the gain to show that tax of the 372. Okay? All right. That is capital gains, and that's all you really need to know. And I know it's a lot of material in the book, but I just wanted to kind of simplify it best I could there. Okay? All right. I'm going to open up. Any questions?